Welcome back, everyone, to Tactical Monthly Update. My name is always Michael LeBlanc, Senior Portfolio Manager at LLC Private Wealth and Canaccord Genuity Wealth Management. Remember, these videos are for educational purposes only. Always do your own due diligence or give us a call, even better. We're happy to discuss your particular goals and needs. So with that, let's kind of jump into our November update. Just be aware, we're filming this on November 28th. So I'm going to talk about the portfolios, I'm going to talk about the markets and some return numbers. They're approximate month-end numbers because we actually haven't closed the month off. We will put the exact numbers up on screen here. So when you hear me talk about the numbers, keep in mind they might be slightly different from where we close off the month. Let's start with November review, and we can't review November without talking about the election. So obviously, we had the election outcome on November 5th. It was a clean election. We knew right away the winner. But as I mentioned last month, our real concern wasn't who won. We definitely had an election bump in the markets. We've had a great rally in November. The overall markets have been up between 3 and 4%, depending on which index you're looking at, and again, approximately. And the portfolios as well,
just over 5%.
Depending on which portfolio you're looking at, and we'll have the exact numbers up here. So we knew that bump was going to happen. It didn't matter who won. Markets tend to want to know who won the election. They don't like uncertainty, so that uncertainty moved away. We knew who was going into office. We knew which party. We kind of knew their agenda. We knew which sectors were going to benefit from that, and that's where we've seen this nice rally in November. Kind of moving into, hopefully into December with that continuing. So not a big surprise there. The real big outcomes from the election, as we mentioned last month, the House and the Senate, of course, both going Republican. Very tight though, especially with some of the nominations that we've seen. It's going to be a pretty tight vote in both those things. And they're going to have to face that budget constraints, debt ceiling in January, taxation, and dealing with the deficit spending that the U.S. has been experiencing, especially for the last couple of years. So with that, let's move on now to the portfolios themselves. So as I mentioned, another great month for the portfolios, and I'll talk about two of the portfolios specifically. One we call RP7, or Risk Profile 7, which is a pure equity portfolio. It's now coming in, it's trailing 12 months in the
27-ish range.
And we'll have the exact number up here. And our RP6 towards more of a balanced approach, or a balanced growth approach, coming in roughly around
22%
number for the trailing 12. Also happy to talk about our all-cap portfolio, which I've mentioned several times over the last year. It's a newer strategy that we put in place. Same principles as the other two, but designed to have higher returns, a bit more volatile, and but expanding beyond the large cap. So over the last 12 months, we're going to have a final number. It's going to be up here. It's in the 31-ish range. Now I know that sounds the same as our normal equity portfolio, and that's because the large caps have dominated in 2024, and the all caps power is going to come in a more diverse or a more broad market rally, where the mid caps and small caps tend to outperform sometimes. And that's what we're actually looking forward going into 2025. And as far as the portfolios goes, with the election, we've been shifting into consumer staples more, possibly looking at inflation returning to the storyline. I know we thought we got rid of it, and we thought it was behind us, but we might be seeing that a bit more, and I'll talk about a little bit more about that in a second. And of course, we really like the utilities, especially the power companies. CPX in the portfolio continues to really outperform. I'm not going to throw a number out just because we don't have the month-end numbers on it yet, but it's really been rallying. We bought into it just between $39 and $40. My last glance at it, it was just under $62 a share. So continues to perform amazingly well inside the portfolio, as well as a bunch of other names. But we really like that power sector. So let's look a little bit forward. We've got a new government coming in the United States. We've got a lot of things coming up. Obviously, tariffs have been the big word of the month as the new government down there is talking about using tariffs to a large extent. And really, let's put the word tariff aside, because everyone thinks tariff, how's that going to affect Canada? How's that going to affect Mexico or Europe or China? It's not really. All the tariff is a consumer tax on Americans, right? It's a GST tax to Americans, straightforward, because they're going to pay it on all those imports. As far as Canada goes, which is a big question we're getting these days, I actually don't see it as a big concern, not for the consumer staples, because Americans those are staples, they need it. They're going to pay the 25% or 20 or 30, wherever the tariffs end up landed. They're going to pay it because those are staples that they need. They're going to continue to import that from Canada. They can't produce enough locally, or they can't source it anywhere else more efficiently. Those are going to continue. The consumer discretionaries, 100% be concerned. That's why we moved away to a large extent from those sectors, both here domestically and also emerging markets, because they'll be affected by those tariffs as well. But the real impact looking forward, all through 2022 and early part of 2023, my videos, the theme was inflation and interest rates. Now, the buzzwords you're going to hear from me for the next year are going to be budgets, spending, and inflation, or revenues, because really what the tariffs could cause, we don't know yet. It all depends on how they're implemented and how they find this balance between spending and revenue, because they do have that deficit to deal with. And the revenue source they seem to be focusing on is these tariffs, or as I mentioned, a consumer tax. So if they can come to a balance, great. If not, what they're going to end up doing is reinflating the U.S. economy, maybe interest rates hike later in 2025. That changes the strategy, that changes the game. We won't know that at least until the end of the first quarter 2025. So that's why we're going to be focusing on those discretionary sectors and moving away from, the staples sector and moving away from discretionaries. Really, that's the theme you're going to want to watch. Forget about all the noise around the politics and who's saying what. It's all going to come down to spending and revenue sources. And remember, that's going to be during a period where if they execute on their plan, they're going to be getting rid of a lot of cheap labor, especially in agriculture, which means they're going to have to import more goods as their agriculture production could see significant drops if they're losing those employees. And that's just one of the obvious sectors we're going to see. So with that, I'm going to close off the video. As always, reach out to us if you have any questions about your portfolios here or exterior. We're happy to do a review and comment. This is actually a really good year to look at some of your external portfolios. Have they been keeping up? Have they been managing the risk? Have they been taking advantage of the growth? We're happy to look at that and just give you comparisons, make sure you're getting the best value for your investments. And as always, any feedback on these videos or anything else we do, please always reach out. You can reach us at email, phone, and if you want a quick, easy link to remember to our website, mikeonmoney.com, will take you to our main website as well. Thank you very much. Talk to you next month.